Hello, chart watchers, and welcome to this Thursday, February 15th Market Watchers live show with your hosts, Tom Bowley and Erin Swinlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, as we like to say, a lot of interesting action out there again today. We got the Dow Jones Industrial Average shaking off some earlier losses. I've actually got a 2-month chart up here instead of 2 days for a reason. But I want you to see the moves that we've made here recently on this rally on the Dow Jones, getting back up close not only to the two key moving averages, the 20 and 50-day moving averages, but also getting very close to this reaction high off the first wave of selling that we saw back in early February. So I think we're getting close to a key level. Check out the S&P 500, same situation. Beautiful rally, but now getting close to key levels of resistance. The NASDAQ actually has taken out the reaction high that we saw earlier in February. So a little bit of relative outperformance by the NASDAQ, which I like. We do still have the 50-day moving average above that we need to try to negotiate, or excuse me, 20-day moving average. And then the Russell 2000 lagging a little bit, still trying to get up to both of its moving averages. But it too has seen this very nice rally. 10-year Treasury yield, going to talk about this in a little bit, down to 2.89%. Currently, we did get up to 2.92 earlier, and we started to roll back over. Volatility index, I think, is at a key level. So as we're seeing some key resistance levels being challenged on our major indices, we've got volatility index moving back into the teens. And let me just say that during both bear markets, 2000 to 2002, and also 2007 to 2009, volatility index never went below 16. So for those thinking that this is the start of a bear market, I would really be watching this level here on the VIX. A couple of industry groups in the industrials doing well today. Aerospace trying to make a breakout above both of its moving averages. And you can see the distance between its 20 and 50-day moving average much stronger than the overall indices. So we're seeing some relative strength here. And also check out defense breaking to another new closing high potentially. So we're seeing strength there. Part of the problem I have with today's action, utilities are leading to the upside, and right behind them on their heels, consumer staples, two defensive groups. I think we have to be careful there. Energy having another rough day today, and you can see that the exploration and production index also down today. And these are, this is not good because you can see that the exploration and production index really has not bounced that far off of the recent lows. Just and the XLE overall, of course, driven a lot by ExxonMobil and Chevron and Schlumberger, but this ETF struggling as well. And with that, I am going to bring in my co-host, Erin. How are you doing this morning, Erin?
I'm doing just great, as usual. Nice, bright, sunny day, blue skies. I'm not sure what the high is going to be today, though. It was a little chilly yesterday. The high was only about 63.
Yeah, the market right now has got some sunny skies, but I see clouds on the horizon. I'm a little nervous with today. I've been, pretty bullish. We've been getting this nice rebound, but today I think this is where, we're going to see if the pedal meets the metal and whether or not the market's got enough to get through some key levels. A couple positives out there with the NASDAQ outperforming, but there's a lot of overhead resistance that the market is going to have to deal with. And yeah, and the volatility index all the way back to where it started when we had that huge sell-off. We ran from about 17 to 50 in less than 2 days. And so we're back to 17, back at the scene of the crime.
Indeed.
So, and we've got a great guest on here today. Returning is Julius de Kempenaer. Julius, how are you doing today?
I'm good, Tom. Thank you very much. I'm glad to be back.
Well, we are glad to have you, especially with this craziness in the market. I hope you can maybe straighten it all out for us.
Well, I'm not so sure about that. I had some other plans with you, but we'll have a look at that too.
All right, sounds good. We're going to get back to you in about 10 minutes or so. And Erin, I guess if you want to go through the announcements and the agenda,
Absolutely.
We'll get started.
Sure thing. I've got a workshop tomorrow. We're going to talk about bull and bear market rules. I think it's appropriate right now. And then a reminder, the market is closed on Monday, so we will not be here. I know you're going to miss us, but we are going to take a holiday just like you. On the 20th, Arthur Hill will be coming in for me. I won't be back for my 3-day weekend, so he's going to cover. And then we have Greg Schnell coming in on Wednesday. So that'll be really interesting to talk to him about commodities for sure. But for today, What do we have on the schedule today? Well, I think it's, as you heard, we're going to have Julius de Kempenaer starting our show off after technical news. And I know everybody's excited to have you back. We've had lots of requests. 10 and 10 to 1, I'm taking your symbol requests right now in the live chat room. And the first one we're going to look at is AK Steel Holding Corp, AKS. So if you want to go take a peek at that chart, go right ahead. And we're going to finish off with Anatomy of a Trade. And Julius has graciously accepted the challenge to join us on the Anatomy of a Trade. So that'll be very interesting to see how you go in and find your trades. So looking forward to that. And with that, I'm going to pass it right back to you, Tom, for all of our technical news.
Yeah, there was a ton of economic news out this morning. So let's take a look first at the 10-year Treasury yield. And you can see we're down a little bit. And one thing I'm watching on the 10-year Treasury yield is we're starting, looks like, to roll over on the PPO. We've had a huge run up here. And I think the momentum to the upside here on the Treasury yield starting to slow down. And a pullback here might not be great for stocks within the financials. And in fact, when I looked earlier, I think financials were one of the aggressive groups today that are struggling a little bit. And so maybe some of this momentum seems to be slowing in the bond market, or at least in the selling in the bond market and the move higher in the yield could be starting to play a little bit of a role in the financials. I don't know. But we got a lot to talk about here. First, we had initial jobless claims out this morning, 229,000. The market was looking for 230,000. So a little bit of a beat there. February Philadelphia Fed survey came in at 21.0, market looking for 25.8, so not quite as strong. January PPI, this is the producer price index. It rose 0.4%. The market was expecting a rise of 0.4%, but it was the core PPI that actually had a little surprise, rose 0.4%. The market was only looking for 0.2%, so a little bit hotter on the core rate. February Empire State Manufacturing Survey came in better than expected, 17.5, the market looking for 13.1. And then just before the market opened, we saw January industrial production come out, minus 0.1%, market looking for plus 0.2%. And January capacity utilization, 77.5% versus the market's anticipation of 78.0%. So both of those would maybe indicate that things are not quite so hot in terms of factory and manufacturing. And in addition to the January report, the December industrial production was revised lower from plus 0.9% to plus 0.4%. So a pretty significant reduction in December industrial production. And December capacity utilization also revised lower from 77.7% to 77.5%. One last report came out 10 a.m. this morning. February housing market index 72, and the market was looking for 72. So a little bit of mixed reports all over the place, but you can see the 10-year Treasury yield in a fairly narrow range so far today. And it's going to be interesting to see whether or not we can continue that, or if we start to move lower. We have not even tested this rising 20-period EMA since back at the end of 2017. I mean, it has been pretty much a straight up run in the yield, meaning money is rotating significantly away from bonds right now. And that does tend to be bullish for equities because that money has to go somewhere. So I think it really comes down to why are yields going higher. If it's simply to fight inflation, that money probably isn't going into equities. But if it's because of a stronger economic picture going forward, and that's generally what we see out of the bond market when it starts moving like this, when the yield starts moving, then that would be very good for equities. And typically what we see during short-term advances in the 10-year Treasury yield is an S&P 500 that generally goes up with it. So really interesting what's going on with all the dynamics. Let's take a look at the VIX, because this was obviously the topic and has been the topic for the last couple of weeks. But this is what I was talking about. We made the huge move, and if I'm going to pull up the S&P 500 and put it on this chart as well. Because I think if we take a look at the S&P 500 and we look at what happened to the S&P 500 just a couple of weeks ago when the VIX was spiking. So here is the big move up in the VIX. We went from below 15, really up just above 50 in less than 2 trading days. And look at the S&P 500 during those 2 days, falling from about 28.25 all the way down. Well, initially we were down to roughly 2650 or so on a close. Now intraday, and if I pull up the S&P and pull up the candlestick here, let's look at candlesticks. You will see that intraday low, the line chart wasn't showing a big move down here on this particular day, February 6th. But now you can see with candlesticks, we were down another 50 or 60 points on the day when the VIX, went shooting higher. So this was a really rough period. We're now moving back on the S&P 500. We're getting in close to this reaction high off of that initial low. We did put in a lower low. I mean, this could set up as an inverse head and shoulder pattern, which is very bullish. And I'm going to be looking, honestly, I'm looking for some type of a bullish continuation pattern to develop. And maybe we just get a V bottom. Maybe we just go straight down and straight back up. But I think that probably would be the less likely. I'm not saying it won't happen, but I think that's the least likely. Just because we needed selling for so long and we finally got it on very heavy volume. The move back up has been on lesser volume. And so these overhead resistance areas, I think, are going to be pretty interesting. But the VIX getting back down to 1760 today, again, from a week and a half ago up at 50. So we've seen volatility really flatten back out again, and a move back below 16, and it would really begin to argue against bear market thoughts. Because a bear market, as we saw during the last two bear markets, the entire bear markets, the volatility index never went below 16. So you need a certain element of fear and pricing in of that fear in terms of the options. That's what the VIX really does. It's an expected volatility. Looking at the S&P options going out 1 to 2 months, you need that fear out there. And so it's been coming back down quite a bit. And I think with all of this overhead resistance and hitting this key area of support on the VIX, I think this is really going to be the key area in determining whether or not the bull market is ready to resume or whether we need another plunge to the downside. I will say, though, yesterday with a lot of bad economic news out and the market, the futures dropping the way that it did before the market opened, we saw the Dow drop almost 500 points in less than 5 minutes after the inflationary report came out and the horrible retail sales numbers. But then the market came right back and we actually extended our our streak of consecutive days moving higher to 4 yesterday, trying to make it 5 today. So anyway, I think that this is going to be a very interesting level. So if we pull up the S&P and again, take a look at these moving averages, you can see that we are moving right up into this territory. We had a death cross, which is the short-term moving average, moving below that long-term moving average. And again, off of some very heavy volume, the selling and then the reaction high, we got up to about that 2730 area, and we've got gap resistance at 2741. And if you hit this inspect button and drag it back over the big candle here when we saw all that selling, you'll see that the open on the that little rectangle there, the open 2741. So it just gives you an idea of where you might be looking at some possible overhead resistance. And if you missed it, might as well bring it up again. Let's annotate this. And let's take a look at the Fibonacci retracement tool. And here we can take a look from the recent high down to the low. And just drag this down just a tad. There we go. Okay, and you can see that the key reaction highs, if you're looking at Fibonacci, the first one I like to follow is at 38.2%. We got right to that 2 days ago. That was back on Tuesday at the close, but we went through it. And now we yesterday challenged 50%, which was 2703. We're now above that at 2709. And that final one comes in 61.8%. That number is 2743. And we've got gap resistance there at 2741. So I've said the last couple of days, and I do believe that the next 30 points here on the S&P 500 are going to be a lot more difficult to negotiate than what we've seen over the last 4 or 5 days. And during the sell-off, you can see that the volume bars were much heavier than we saw during this move back to the upside during the gains. Now, I would even say that this heavy volume reversal, this was important because when we get into the anatomy of a trade, you'll see that there were some key moves on individual stocks down to certain support levels, gap support levels mostly, that reversed off of it. So that was a very important day, but a lot of this volume came on the selling. early in the day, and then we got the reversal. And there was pretty good volume on that reversal as well. But anyway, I think looking at that Fibonacci gives you an idea of some overhead resistance levels to keep an eye on. All right, let's take a look at a couple of companies that reported earnings. Cisco reported last night after the bell. They absolutely blew it out of the water. $11.89 billion in revenues. The market was looking for $11.82 billion. And then bottom line, 63 cents. Market looking for 59. Got a beautiful gap up, but I do not like that black candle sitting there right now. I would expect, unless Cisco reverses later today, that probably the open today is going to be a key resistance level now going forward. And I wouldn't be surprised to see us come back and at least test the bottom of this gap. Applied Materials, another one that came out after the bell yesterday. Applied Materials also had some pretty good numbers. $4.20 billion on revenues. Market was looking for $4.10 billion. And earnings per share, $1.06. Market looking for 97 cents. And you can see the move back up, though. We're up into this gap resistance, these moving averages. A lot of indecision here with these long tails off of both sides. So I would be maybe a little careful with Applied Materials here. Wouldn't be surprised to see it roll over as well. The last one I wanted to look at from last night is Network Appliance, NTAP. Also beat on the top line, beat on the bottom line, 99 cents versus 90. But there were two analysts that came out basically saying that they were still just neutral on Network Appliance. They loved what they're doing, but they just think all that's been priced in. So I think on Network Appliance, I'd be watching this top of this gap support. I think a move back down to around 51 would be very interesting. You can see the buyers. Every time we get a little bit of weakness here, these long tails tell us that there are buyers stepping back in. One stock that was upgraded this morning, CRM, actually a couple of stocks, but CRM was one of them, gapped up currently with that black candle. Again, I'm a little bit nervous. Still has to try to negotiate 114 overhead resistance, but it is starting to strengthen, at least in terms of momentum. You can see the PPO holding that center line support area and starting to move back up again. I find that to be bullish. And then we've got Baidu. Baidu really strengthening, having a beautiful week, up about 14% this week. Huge move. This was earnings related yesterday, and now today they get an upgrade, and the stock continuing to make a push back to the upside. Looks like maybe 260 is within range here on Baidu. Finally, one downgrade, PDCO. You can see that the stock had been going down. I'm not sure if this was earnings related. Very heavy volume, gap down. We did get a hollow candle, so maybe off of this selling, trying to put in a bottom. Even with the downgrade today, the stock was down quite a bit more earlier. It was down as low as 30.58. Now it's back to 30.97. So maybe the worst is in with this hollow candle, but I would play a trading range on this one. I think the 29.75 level to the downside is an area to watch, and then you can see all of these tails representing support between about 32.50 and 33 to the upside, and it won't be long. You're going to have that 20-day moving average falling down into that territory as well. So I think it's in a trading range for now. And with that, I am going to turn it over to our good friend Julius de Kempenaer. Julius, what do you got for us today?
Hi, Tom. I am thinking about doing two subjects, actually. Let me first bring my screen up. Yes, and I'll share my desktop with all of you. I recently wrote an article in my blog. Actually, I've got it up on the screen right now. On January the 15th, and that was dealing with using relative rotation graphs to get a handle on both price and relative rotation in one picture. And that article, and please you go back and read it. It's too much to overview it all now. But that article basically introduces or reintroduces the concept of using the $1 ticker symbol as a benchmark for relative rotation graphs. And the reason why you might want to play around with that and why you might want to do that is because a classical relative rotation graphs, and let me bring up, this is the RRG that you will get when you just bring it up immediately. And if you're a member, you can select various groups. And let me bring up the Dow Jones Industrials RRG because it's a good example. You see it's a bit crowded. It's 30 ticker symbols on the chart. I like to shorten the tails a little bit to make it more readable. And what you will see here is a standard RRG with the stocks pretty much evenly spread out around the center of the chart. Here is the Dow Jones Industrials itself. And you see at least one big outlier, that's GE, very far to the left, improving a little bit at the moment, but for me, not worth, well, maybe a play, very short-term play to the upside, but this is really, really, really a weak stock, so I wouldn't buy this for a longer-term holding. If I see something like that, I usually drag everything to the middle because I know that that one's out there and I'm not really interested into that. And you can zoom in on, all the other stocks and see where they're heading, what they're doing. Merck going the right way, PG the other way, BA actually one of the strongest stocks in the Dow right now, while CAT is dropping. This is all relative to the Dow Jones Industrials Index. Now, obviously, the Dow Jones Industrials Index itself also moves. You can see the brush chart here. It's been a big rally. We've seen the sell-off. It's now coming up again. And this is showing you the relative performance, the trends in relative performance against that index. I come from an institutional background, and there people are very, very interested in relative performance because their job is to outperform a benchmark. Now, in the retail space, obviously you want to outperform, you want to find the best stocks, you want to find the best sectors, but it's much more important to outperform basically zero, your cash. You've got all the liberty in the world, you can go cash when you want it, you can sell it if you don't like it, you don't have to be fully invested. So getting a handle on price performance per se as such could be very interesting, and an RRG actually can help you do that. Now, in order to do that, you want to compare all your securities, like in the Dow Industrials here, not to the Dow Jones Industrials itself, which is a moving target, so to say, but you want to compare it to something that doesn't move or only moves up. And we have something of that in the database, and that is the $1 symbol. And if we stick that simply in the benchmark box and hit enter, you will get another RRG holding the 30 Dow stocks, and it will show you the rotation versus a flat benchmark. So what you're now looking at is price trends. Well, they are relative, but the relative is 1. So the whole, relative comparison against the benchmark is taken out of it, and you're looking at price performance, absolute price performance. And what you will see here, and this is a weekly chart, by the way. I usually work with weekly charts, but we can switch it to dailies, because what you will see here is that in general, everything is still on the right-hand side of the plot, which means that the majority of the stocks is still in a weekly uptrend, as defined by the RRG algorithms, and they take a little bit longer-term trends. Only GE, Merck, and PG are in downtrends versus $1. They are moving up a little bit, but this is still a big downtrend, just a hiccup. Now, if we switch this to daily, we get the similar picture, but now looking at the daily trends, and we will see a little bit more of the recent price action. And the way I plan to do this, I click fit, and then I bring it out a little bit to bring everything into perspective. And this is what you see, what Tom was just pointing out on the price chart. It has bounced, and they start to bounce up again, and you see that Apple is actually bouncing up fastest. You can immediately see that from this whole clutter of stocks. Apple is the one that's leading the pack higher right now. GE as well, but much less, because it has a much less longer tail than, for example, Apple. So to round off this subject, by using $1 as a ticker symbol, you can change your RRG from a relative comparison tool to a absolute price comparison tool. Now let me jump one more thing to make it really interesting, because you can also do both at the same time, actually, because we now have all the Dow stocks here. And let me just put 0 trading days, so it becomes really readable. Now what I'll do is I will add the Dow Jones itself, so $INDU, to the population on the chart. And now we have to do is find the industrials. It's here. Can you see it? Let me highlight it. here. So you'll see this is $1. So this is flat price performance. This is the position of the Dow. So it went into a short-term downtrend. If we add a tail, it starts to move up a little bit, starts to turn around. And you will see all the stocks scattered around the Dow Jones Industrials. So you'll have the price perspective, that's against the center of the chart. And you will have a relative perspective, which is versus the dollar index towards the Dow Jones Industrials. And you can imagine that you can do that with, for example, the sectors. So if we bring up the S&P 500 sector ETFs, and we change this to $1, and we add SPY, ta-da! Now we have all sectors versus price, and SPY is positioned here in the middle. So you see that the market, SPY, is still in an uptrend, longer term uptrend on a weekly basis. And you see that these are outperforming SPY, and there is one which is really, really weak, and that is utilities. It still is. Nothing I can do about it. That is a weak one. So that is how you can use $1 to get a handle on both price and relative performance in one RRG. Now, the second thing that I want to address here is I'll take a little bit of a different angle, because mostly RRGs are used for, well, the one that we have up right here, US sector, sector rotation. It's a very cool tool. It shows you the rotational pictures. I hope, I take that pretty much everyone who is on stock charts knows that right now. And if you don't, please check out the blogs and the RRGs. And let me know what you think, actually. You can go to the blog and subscribe to the newsletter when anything is published. And if you put some comments and remarks and discuss, I will actually respond to them and answer you as good as I can. Now, instead of using the sector segmentation, I thought of doing something different. And that is actually using different segmentations of the market, like growth and value, and size segments, like large, mid, and small cap. And the one thing that's really important when you do exercises like this, and I'm actually about to finish a blog article on what I'm going to share with you right now, is you got to find a proper set of indices, because with RRGs and relative strength analysis in general, one thing that's very, very fundamentally important is that you compare apples with apples and oranges with oranges. So if you start looking at, for example, let's stick with the sector chart that we have here. These ETFs are all spiders. They're all calculated by State Street, based on S&P sector indices, and State Street builds the spider ETFs on that sector family. Now, there is a similar set of sector indices done by Fidelity, very likely also by Vanguard, maybe some other ETF providers as well. I don't have a preference for either or, but if you want to look at sectors, please make sure that you use all the sectors out of the same family. So if you want to use the spider family, please use these ticker symbols. If you are a Fidelity client and you like to use the Fidelity Select Sector ETFs, make sure that you put all the Fidelity ticker symbols on the plot. Actually, I might, here, Fidelity Sector Funds. I've done that a while ago. So here you got the whole Fidelity family of sector funds. It's a little bit more crowded, but just to give you an idea, what you want to do is you want to stick with the same family of indices. Now, what I started doing is started digging through the stock charts database to find a proper set of indices, and I came across the Dow Jones family of indices, and they all start with the dollar DG, and then you'll get a heck of a lot of indices. And I started using the, let me go back here, growth versus value. That's where I start. It's the high level overview. So here you have an RRG which shows you the Dow Jones US Growth Index versus the Dow Jones US Value Index. And the benchmark I've picked is the Dow Jones US Index. Don't confuse this with dollar Indu, which is only 30 stocks. The Dow Jones US Index is actually an index that covers about 95% of the total market capitalization in the US. And here you will see both the growth and the value segments. And I don't know, you don't have to be a rocket science to figure out which one is leading. It is clearly the growth part of the market that is leading, and it's been leading for quite a while. You see that, we had a few weeks down and it quickly reversed further up. But if we play the animation here, let me max that out so we see everything. You will see that pretty much since April last year, they stayed on the right-hand side, and growth has been outperforming value for many, many months right now. And we had a brief period where things seemed to be moving the other way, and that started happening early January when they started to roll over. Still, anything on the right-hand side is in an uptrend. Everything on the left-hand side is in a relative downtrend. This means that the uptrend is going through a little bit of a correction, and the downtrend is going through a little bit of a hiccup. There has been no crossover yet. There's been no change in leadership. It's still for growth, and it continues, and then all of a sudden, this was, early Feb, we started to bounce off that big move, and we're now shooting. And what you can also see is that the distances between the observations are actually getting longer, which means that there is power and momentum behind the move. So based on this chart, my preference now, I have to say very, very clearly, is with US growth stocks. Okay, so mental memo, US growth stocks, that's what we like. The second sort of segmentation that we can do is based on size segments. So we stick with Dow Jones US, the Dow Jones US overall index, and we stick in a number of size indices. Let me take away this one here, make it more clear. We can have actually a little bit longer term tails, because space enough. When you have only a few elements on your plot, you can work with longer tails because they will all remain visible. And if there is a lot, like we just had with the Dow Jones Industrials, you take a little bit shorter term. It's a bit balancing act between the number of securities you want to look at and the length of the tail. Now here, the message is also pretty clear. It's the large cap segment on the right hand side, which has just rotated from leading through weakening and back into leading just about. Stay very close. It's a very stable trend, not much going on. Compare that to the very long tail that we've seen in small caps. And that actually makes sense, because this is what's called a closed universe. That these three size segments cover all of the Dow Jones US index. So you can expect the large cap component to be the biggest part of that. So it stays naturally, mathematically close to the center of the chart. And the small cap segment has a lot more leeway, a lot more room to move around, because it responds much faster to differences to the overall index, much faster than the large cap index, because it makes up such a big part. Now the message that this RRG is sending us is that large cap actually, well, basically it was doing right. It went through a little bit of a corrective mood, never crossed over to the left-hand side of the plot, rotated back into leading, and is now at a strong RRG heading between 0 and 90 degrees. That's what we like to see, gaining on both axes. So for the near future, I expect the large cap segment in the US to actually continue to outperform the broader market, and especially the small cap segment. So if you're in any type of trading, any type of portfolio, you would overweight large cap holdings over small cap holdings. Now, we have had large caps, we have had growth and value, but you can actually dig one step further, because the same family of indices also breaks down the value segment and the growth segment into size segments. And let me bring that up. I've called these sized value and sized growth. So sized value is this chart. Let me quickly take this away here. This is, let me show you the table. It's the Dow Jones US Large Cap Value Index, the same Mid Cap Index and the Value Small Cap Index. And please note that I am now using the Dow Jones US Value Index as the benchmark for this group. So earlier we were using Dow Jones US, which is the complete market. Now we are using the value segments to compare it against the value part of the market. And again, we now have a spread out chart. And what we see is that the large cap segment of value is to be preferred over mid and small cap. Pretty clear picture, actually. Now, here's the trick. Remember what we just did with $1 and $Indu on the 30 Dow stocks to compare it basically against 2. We can do the same here. We can bring $DG US VA back into the comparison. I'll run it once because then you'll see what happens. It's positioned in the middle because it's also the benchmark. Now watch this. When I change the benchmark of this chart to $1, you will see that $VA will also start to move. Let's bring it back. They're all very close there. Here is VA. So VA is leading over $1, which is logical because pretty much all markets are going up. And you see that large cap is better than the general value, and it's better than mid cap and small caps. And now you have a handle on both the comparison against price. I'm sorry, this is not good. I should have done. Sorry about this, guys and girls. This makes more sense. Here you go. We can actually do the $1 as well, but here you will see VA, which is negative versus the overall market, which is what we just saw in the growth and value comparison. Here it is. You see it coming back at the same spot. And now the size segments for value are scattered around the big value index, but they're all underperforming the bigger market. And the same thing we can do for what I call sized growth. Here we have, again, take this one away. Here we have the size growth segments compared against the overall growth index. Growth large caps outperforming the growth and again the mid and the small caps, of course. We can do the same thing, bring $DG US growth back here and change this to the overall market index, Dow Jones US. And now we see the improvement of growth large caps over the overall growth segment. Let me make it a little bit more readable. Here is mid cap and small cap. So basically, all the growth indices are outperforming the broader market. Large cap is outperforming growth and mid cap and small cap. So we've now sliced and diced basically the whole US market into value and growth, and we subsegmented that into mid and small. And the final step of looking at things is to bring that all into one RRG. And here you have the complete US market with the Dow Jones US as the center. And let me work you through this, because I'm not sure if you know this little trick, but you can actually, because I have a hard time reading all this and figuring it out, especially if you enhance the trails a little bit to get a little bit more of a handle of the rotational pattern. And the solution to this problem is to select one of them, show the chart, and now you can very clearly see that growth large cap is leading pretty much everything. Now watch this. What I'm going to do now is I'm going to hold down the control key, and I'm going to use my arrows, my up and down arrows, to toggle through that list. So control down shows me this is US growth. Very strong, but not as strong as growth large cap. You see growth mid cap, and you see growth small cap. And here is US large cap. That's the whole large cap, so both value and growth in one index. This is everything. Where am I now? Why am I not seeing that? Oh, that's the one I toggled off. That's the general market. Makes sense. Here is the US mid-cap segment, weakening, turning back to the lagging quadrant against the global US index. Here we see US small caps. That's the big small cap index, so value and growth in one index, all small cap stocks. Here you see US value large, so that's all large cap value stocks. Here you see value mid cap stocks, not very strong. Here you see all the value stocks, which is the first one that we started with, value against growth, which was somewhere here. And here is the weakest of all, which is value small caps. There's nothing I can do about it, but this is really the weakest stock in the universe. And now we've done all of them. So let's have a look at both of these charts, because that's where you can find pretty cool trading ideas. So what we're going to do is we're going to have to make a note of that. I'm going to look at a chart of US growth large cap, and we're going to compare that with US value small cap. Bring up a chart here. I can just bring that one up. I've set that to always load the ticker symbol with the relative strength against SPY and then the RRG lines against SPY. Clearly, that's not what I want right now. So right now here, let's start with the comparison against Dow Jones US. And do the same here. So now we see large cap growth stocks against the US market. Well, I mean, this chart is still looking pretty awesome. Yes, we've had a pretty nasty decline, but as far as I'm concerned, the good news is that this low has held up higher than the previous lows in this series of higher highs and higher lows, which is my definition of an uptrend. So we're still good there in terms of price trend. But what I really like is the fact that we just broke out to new highs on the relative strength line, and that definitely helped the RRG lines to bottom out, the RS ratio to bottom out above the 100 line, and the RS momentum line to come back above the 100 line. And this is a typical rotation of leading, and then here it crosses into weakening, and then it crosses back up into leading. So we had leading, weakening, back into leading, which we know is a very strong signal. So for me, US large cap growth stocks still, a very strong market. Now the other one, which was completely on the opposite side of the spectrum, was Dow Jones US value small caps, and that still comparing to the Dow Jones US index. Ooh, completely different chart. Look at this. I mean, in price terms, I'm already not very happy with this. Let's annotate that a little bit. Probably draw my trend line somewhere here. It's broken, depending a little bit on how you draw your trend lines. Always a very subjective element for me, drawing trend lines. It broke it, bounced back up. Maybe you want to say it held. What I don't like is that this low is well below this low. Maybe we say these are the same. Anyway, in any case, it's not as good a chart as the one that we saw from the large cap growth stocks. This one definitely got hurt a little bit more. But where it got really hurt is on the relative picture. We had this staking out the lows here. Not convincingly yet, but it is lower. And if we bring this one in, then it's definitely lower, and you have a series of lower highs and lower lows. The RRG lines topped out even below 100. So this is a rotation into lagging, improving when RS ratio is still below 100, RS momentum is above it, and then it rotates back into lagging without crossing over into leading. So this is definitely a weak picture on the RRG chart. Now the final thing that you may want to do is put those two against each other. So we have growth large cap, update. There you go. And now instead of putting against Dow Jones US, now I need my notes. It's Dow Jones US value small. And I'm going to do this. So what I'm doing now is I'm looking at the same chart, the growth large cap, but now my comparison is against value small cap. Pretty similar, but even stronger, especially if you look at this chart here, that red strength line. That's actually a pretty nasty breakout on the upside, or it's strong in terms of large cap growth. Look at this. This is a very neat and clear break. So having used RRGs to slice and dice that US landscape into both growth and size segments, my take for now is that, let me bring this back to everything, that the growth large cap segment is the one that is to be preferred. And then actually, and I can hear you think, and yes, you can do that. You can now, for example, look into the various sectors and pick some large cap stocks, large cap growth stocks in the various sectors to play this this view actually. There's one more thing. I've got 3 more minutes. I'm not sure if any one of you is following me on Twitter, but I tweeted out a chart very recently with a poll attached to it, and the chart was actually asking, or what it showed a chart, and I took away the price and time and everything. It just looked a number of bar charts, and the question was, is this bullish or bearish? And I can't show you well, I might actually be able to do that. I can show you the Twitter feed. No, too much time. Go to my Twitter feed and you'll find it. It was actually the XLY XLP, consumer discretionary versus consumer staples. And as you may know or not know, is that is a pretty good ratio for risk on, risk off. Generally, when discretionary is leading over staples, it's risk on, because that's good for the markets. And when staples are seen as more conservative, more defensive, that would be a risk off. Now this is a 20-year chart of that ratio, and look what happened. We just broke to all-time highs, and we moved away as if not. They never look back. So I personally think that this is pretty bullish for the overall market. I'm not sure how long this is going to last, but I've seen breaks of this magnitude in normal stock charts in normal markets that just were the initial start of something much bigger. No idea whether that's going to happen here as well, but I thought it's something to share with you because I concur with some of Tom and Erin's comments and worries about the markets. You know, it was a bit of a nasty move that we've seen. We're recovering very rapidly right now, but the recovery has to continue to keep up this good work. And what definitely should not happen in terms of the S&P is a break back below 2600. That 2600 level is pretty important, I think. So if we dip back below that 2600 level, then I am inclined to say that all bets are off and it's going to be much, much worse. But as long as 2600 holds up, we're in pretty good shape. And this ratio, if it still holds any value and validity, basically is suggesting that, you know, discretionary is going to outperform staples for a very long time. And if all theories that we've been working on for the last 20 years are still valid, then, I don't know, we're still in good shape. So I'm going to watch these markets very, very curiously and very, very closely. I for sure will keep a close eye on this XLY XLP relationship, because it has proven to be a very good indicator for risk on, risk off trades. For the time being, I think we're still in good shape. Longer term, maybe we've got some wild days going, you know, ahead of us, but the longer term chart for now looks pretty good.
Yeah, I would just add, first of all, a great presentation, Julius. I know everyone was really into it, watching it intently. There were some questions. I think maybe, I don't know if it'd be easier to go back and maybe go through the chat while we're doing the 10 and 10 and maybe try to answer some of those questions.
Yes, I've been trying to multitask because I'm doing my presentation on one screen and I've got the show on the other screen. So I'm trying to keep up with the with the scrolling messages. But yeah, Erin, you're a girl. You can do that. We are guys. We can only focus on one thing at a time. So I'm sorry. But what I'll do when you do the rest, I will read through the chat and pick up some things, and if I can address a couple of questions, I will do that later in the show. All right?
Sounds good. There are about I wrote down about 6 or 7, so there's in there for you to answer.
All right. I will now start to focus on the chat and keep my ears open if you think you need me on the show.
Actually, before you go do that, we're getting ready to do the 10 and 10.
Yes.
And what I like to do is pull up everybody's requests on an RRG.
That's exactly what I was going to try and do. So I will make notes of the. Do you have the ticker symbols already that you want to do?
Indeed, they're right here.
Oh, all right, there you go.
So yeah. I'll show you the RRG. These are all our 10 and 10 requests.
Cool.
And would you recommend daily or weekly? Because we're looking very short term. Should be daily.
Then if you want to really do the short term, then you want daily. There's no question about it. Actually, I'm gonna put the pressure on the guys at Stock Charts. I've discussed with the chief honcho at Stock Charts whether we could get RRGs on intraday timeframes as well. I think that would be a real awesome addition if we could go down to like hourlies in 10 minutes and that kind of stuff.
Oh heck yeah, we'll all vote for that.
So I'm not sure if Chip's listening in, but here you go. There it is. It's out in the open now. So the pressure is on.
So here's the table, and
he's not going to listen to me anyway. So
no, he doesn't listen to me. Especially when we're asking for extra things like that.
Yeah.
All right. So.
All right. Go ahead.
All right. So here's what I have here as far as the table goes. And typically what I do when I pick the stocks for 10 and 10, I do try to stick to some of these that are beginning to, improve. So I don't know if that's a good way to look at it. I mean,
yeah, if you bring back the plot and maybe put the tail to, let's say 5, because then it becomes, that's enough. And now put it in the, zoom it out a little bit. No, the other way. Then now it becomes even more small. Yeah. So let's see what we have there. I would look at that VRX thing. That really stands out.
Yes.
That could potential. It's still weak, but it's got some potential.
Okay.
I would have a look at RCAR because that's very far away. It's rolling over, but it's 125. It's really.
I want to see it.
Really a strong one. So that's definitely worth a look. My bet, I have no clue what kind of stock that is, but my bet would be that it's in a very strong relative uptrend against the SPX, and it's losing some of its momentum, but the overall trend is still very, very bullish, very, very strong. So I'll keep an eye on that. And what I do now is I put the center of the chart in the middle and then zoom in, because we've seen RCAR and we've seen that other one. So yeah, now zoom in. BMY over there and ANAT, they look pretty good.
Okay.
I would have a look at those. The LPLA still okay, but it's flat, so it's probably not as exciting. So BMY and ANAT. You could pick COPX, which is in the blue, very close to the benchmark, which is a little bit dangerous because it's very close to the benchmark, which usually isn't the best thing, but it starts to increase in distances from observation to observation. So it could be the start of something. It's worth a look.
All right, 3 more.
And then STX moving to the left, and MZOR for a negative view. MZOR right next to your cursor right now in weakening, because they start to decline and they start heading to the lagging quadrant. So we'll have to keep an eye on those, whether that trend is still valid or whether it's in danger. And then VIPS actually is very interesting because that one is on the right-hand side of the plot. It's very strong and it's been turning up. It went through a little bit of a correction and it's now moving back up. So I bet that if you scroll through time with the slider, there, then it's so far away. Just put it back on. You will see that it actually came out of. You have to put it back on the chart.
Yeah.
There it is. Yeah. So it came from leading down into weakening, and it's now turning back up again. That could provide a very good opportunity.
All right. Awesome. Well, let's go take a look at these, Tom.
All right.
You can go answer all those questions.
Yeah, I'm gonna read some chats.
All right.
Ciao. Talk to you later.
All right. And so with that, Tom, go right ahead, and we'll start with our first one, which is AKS.
Okay. Well, kind of in this theme of relative strength, I thought I would pull up a chart where I've got AKS, AK Steel. I show the chart of AK Steel going back the last several months, then also chart of Steel Index, which is where it is a part of course. And then I show AKS relative to its peers in the Steel Index, and then AKS relative to the S&P 500, and then Steel relative to the S&P 500. So Steel actually has been doing pretty well since about mid-November. We had multiple bottoms on a relative basis, so that group started to perform pretty well. And you might look at the AKS Steel chart and think, okay, this is a nice looking chart, and it was performing pretty well here. But on a relative basis, when you compare it to other steel companies, it did okay, but there was no relative breakout. And notice recently when things turned sour again on the index, quickly we lost steam on AKS. So I think what this tells me more than anything is if I was going to go into a steel stock, AKS would not be the one that I would be going into. And especially, I just circled here the test of the declining 20-day moving average. I think this is going to be a big area for AKS, but it is, at least up to date, up to now, it has not been one of the better stocks in the area, in that space.
All right. The next one then we're going to do is OMER. And if I get back there.
All right.
Omeros, yes.
Yeah, I don't like the gap down on the big volume taking out prior support. And I'm talking about right here. You know, it was a stock that wasn't performing that well anyway. You know, with the market soaring at the end of the year, the stock was actually going down throughout January while the market was going up. So you got a really bad relative performance here. Now we got heavy volume and a breakdown. There's really not a whole lot I see here. Yes, it's extremely oversold. So maybe we'll get a bounce at some point, but it's not something that I would rely on from a longer term perspective. So this is a stock that personally I wouldn't go in. It's not my style to try to catch bottoms on stocks that are really underperforming the market. So I would avoid.
All right. Next one is in the healthcare sector, VRX, Valiant Pharmaceuticals.
Yeah, this is one that I was really expecting to see some strength here. So let me pull this one up. VRX. Yeah, I mean, we did get that nice bullish engulfing candle. We are testing the 20-day. This is going to be key, not just for VRX, but for a lot of stocks, the major indices and so forth. We're getting some strength, but notice on this push back to the upside, the declining volume makes me a little nervous. And as far as just annotations, if this was one on my radar and I was watching it, I would simply just put in that right there. I mean, we had a shooting star there where we got above the 20, barely closed above with a shooting star and went right back down. And now here we are testing that declining 20-day moving average with negative volume trends. Volume was very heavy on the selling, coming back up lighter. I'd need to see a breakout above the 20-day with some heavy volume to have any conviction. If I had traded it off the recent bottom, I would be taking profits at the 20-day.
All right. Our car is next, Renova Care, so RCAR.
Yeah, and this was the one that Julius was saying looked really good on the outside, so I'm interested in seeing this one.
Mm-hmm.
Yeah, I mean, you can see on a relative strength basis. I mean, what the RRG charts do is they visualize really well what's taking place in these stocks relative to whatever benchmark you use. And RCAR, I mean, we've seen what's happened to the market over the past 2 weeks. And look at this stock, very strong volume to the upside. It's still, even with all the selling that took place, really not a whole lot of issues here. I think there's 2 key areas of support on RCAR. I think if they fail to hold, you might see, as Julius was pointing out on the RRG, that this RCAR may start to move more toward the weakening quadrant. But for now, I see 2 areas. The first is price support. Right here, we broke out above roughly, $7.15, $7.20, something like that. Broke above on heavy volume, and we have been holding on these pullbacks. So that's the first key area of support. But I would go down to that rising 20-day moving average, because with a strong PPO, with it going higher like this on the most recent high, these pullbacks, I think, present opportunities if we get back and test the rising 20-day. Very similar to what we saw just about a week and a half, 2 weeks ago. So I think RCAR still looks really good. I think volume trends are strong. Relative performance, as you could see on the RRG, is very strong. I have no problems. I would just be looking for a little pullback to improve my reward to risk on a trade.
All right. Next one I have is Bristol Myers Squibb, BMY.
I was looking at this one this morning, and I know there were a list of upgrades and downgrades, and I think BMY got an upgrade today. But you can see on the daily chart here, beautiful breakout, very strong volume today. It's one of the better stocks in the pharma space. So if you take a look at this coming across here, I think it's pretty clear that we have some serious resistance between 65 and 66. We cleared it at the open today, and look at the volume. We're just a little bit past the halfway point of the day today, and we've already traded 8.6 million shares. So we're probably heading for 15 million shares, something like that today. And on a breakout, I think this one's bullish.
All right. Let's see. Next one we have is ANET, ANET, Arista Networks in technology.
All right.
Telecom equipment.
Yeah, and I think they may have just reported earnings recently. I remember looking at the stock. I don't know, maybe it was an upgrade or earnings, but the stock, I think, continues to look really strong. Notice again the rising 20-day moving average. With a couple of exceptions, we closed below, but quickly came right back up. Here, when we went below the 20-day moving average, you can see the PPO had started rolling over with that bearish engulfing candle. So you had a negative divergence with a reversing candle. That normally means a 50-day test. We got that 4 days later, and then we simply resumed our move to the upside. I think the breakout, you might look at this and say, well, isn't that a negative divergence, lower PPO reading with higher prices? By textbook definition, it is. It's a negative divergence, higher prices, lower PPO reading. But check out the volume coming in on this move to the upside. I cannot argue that there is slowing momentum on a stock when it's breaking out to new highs and the volume is as heavy as we've seen over the past few months. I think ANET looks pretty good. And if I, again, annotating it for me, I would just quickly make note that you've got really solid volume here coming in on this breakout, and maybe just draw that breakout coming across here. Because to me, this is now pretty good support back down around 285.
All right. The next one is the Global Copper Miners ETF, COPX. My chart looks good as far as my indicators are concerned. We got a PMO rising for a few days here. 20 avoided a 50-day EMA crossover. So,
yeah, I think that certainly we're strengthening. I think the fact that copper prices overall have been rising, I think, is just further confirmation of the bull market we're in. Copper is a little different than gold and silver. Copper is used in a lot of industrial, by a lot of industrial stocks and so forth, and buildings and that type of thing. So I think when you're looking at copper, I think any kind of a breakout in copper prices is generally very good for the overall market. If you take a look, there's a couple interesting things here. Number one, look at this false breakout. So this is kind of a classic topping pattern to me. You got a move up, the PPO is rising during the entire move. You come down. Anytime you've got that rising PPO on the most recent high, I look for a 20-day test to hold. We did hold. We went back up. Look at that reversing candle. Black candle, shooting star, failed on the breakout, came back down and did it with a negative divergence, which normally is not a good sign, and we went straight down. Did put in a nice hammer on the bottom, rising back up. I look for the COPX to get back up to this 29.10, 29.15 area. At that point, I would take profits as a short-term trader, and I'd wait to see if we get the breakout.
Okay. Let's see, the next one is Seagate Technology, STX.
Great, STX. I think it's a really nice-looking chart. We have great support at about 46. Let me annotate this one using the auto support resistance line right there. So here we gapped up with a black candle, but notice we didn't continue going down. I would have probably expected that, but we kept going up higher. And look at the volume on the move to the upside. That's pretty strong. We came all the way down, printed a doji about 5 days ago when the market bottomed, and that doji occurred right at the 46 level, testing the 50-day moving average and this support area after the gap. Notice also higher prices. The PPO rolled over, and look at the shooting star candle at the top. That again marked the top, and we started heading back down. So I think the stock remains in a very strong uptrend. I think we are just consolidating between 46 to the downside, and let's call it 55 to the upside. We're sitting close to the middle of it, so I don't know if there's anything to do here right now with STX, but I like the pattern. Uptrend, sideways consolidation. Maybe off of this move, maybe what we'll get is a cup, especially if the market continues to be strong. I would expect maybe we get back up to that 55 area. But further out, I expect that we will see a breakout on STX before we see a breakdown.
All right. And I have Mazor Robotics, MZOR. It's looking pretty good as far as my models are concerned.
All right, MZOR. Yeah, I like it. I think it was in a little bit of a channel, maybe a flag off of the recent uptrend. So let's take a look here. So here's the nice uptrend in play. Beautiful looking PPO. We did come back down below the 20, but in setting up this consolidation, I think you can look and see that we had a little downtrend there if you connect those highs. And then if you drag that line, if I can do this, there we go. You'll see that we're in like a little bit of a channel for a period of a couple of weeks. We broke that. We're breaking that today with really solid volume coming in. So, yeah, I think that this one's starting to look much, much better. We were overbought. You can see the RSI was over 70, got down into the 40s, which is typically a pretty good area during an uptrend. And now we're starting to turn back up. So I agree. I think this one's looking much better now.
All right. And our last one, VIP Shop Holdings, VIPS. And this is a broadline retailer.
Yeah, and I recall Julius saying that this one looked good. We've talked about this one last couple of days. Mm-hmm. This is in that broadline retail space. We got back up to the resistance area, and we talked about it, I think, 2 days ago. Maybe as, I don't remember if it was under the radar or one of the segments that we did, because it was performing really well while the market was struggling. Mm-hmm. And then yesterday, I think, was the day we got an upgrade and the stock made a breakout. I think it's come back down literally and just tested the area of the breakout. I think that VIP Shops looks pretty good here, but the price support level that I'm watching is right here. We came back down. We broke out yesterday on better than average volume, came back down, tested that breakout level. If we do fail, if the market rolls over and we do fail, because we do have a negative divergence that we need to pay attention to here. A higher price, lower PPO. We broke out with solid volume, though. But if we can't hold the breakout level, then I'm concerned because we do have that negative divergence. Possibly could go back down to the lows. But I still think that any kind of weakness in this stock actually presents an opportunity. I expect over time we're going to see higher prices on VIPs.
All right. And that concludes the 10 and 10 to 1. And we can see all of the symbols that Tom went over. I will get those up in the Market Watchers Live chart list as well. I try to get them up as the program ends, but I'm not always successful with that. But I will try and get those up. They'll certainly be up by the end of the day. And with that, I'm going to steal the screen back. Let's see here. All righty. So real quick, I know you all might be getting a little tired of hearing about it, but it's going to be such a great conference. August 10th and 11th, we're going to have ChartCon 2018. You do not have to leave your house to attend. It's going to be all online, similarly to the way we did it 2 years ago in Napa. Last 2 years ago in Napa, I think we were at. And if you want to do that, you can register and get your space for the live online event. But if you want to join us at ChartCon, there's more information about that. We will, you'd be able to meet all of us in person. You'd have a front row seat at the presentations. And of course, we have other great events planned. And if you really want to get into it, we're going to be going on an Alaskan cruise afterwards, just about, I think most of the presenters are going to be on it. So you can have even more time to talk with everybody. So something to think about. And with that, I'm going to move into our market update. All righty. And again, I always add the TSX for everybody in Canada. Get lots of thanks for that. So I certainly will continue to do so. All right, let's see what's going on. You know, we had a pullback earlier in the markets, but you can see we're now bouncing off pretty much yesterday's close and are heading higher. In fact, we can see the S&P 500 is now actually flirting with intraday highs at this point, as is the NASDAQ. We're seeing some recuperation on the Russell 2000, and it is now, well, not quite close to its intraday highs, but certainly making a move toward there. TSX also had a really difficult morning, but is now managing to move slowly into the positive. It looks like it broke out from a little bit of a consolidation zone there over lunch. And we can see Treasury yields are down somewhat. UUP is almost unchanged, but it has spent the entire day in the negative. We can see commodities. Again, a lot of these markets having difficult mornings, but we're seeing some recuperation in the commodities. We're almost back up into the positive territory. USO, again, pullback, but has now managed to get back into positive territory. And notice that little bit of consolidation happening right on top of yesterday's close. That tells me we've got a pretty good support level going here, and we should expect higher prices. We can see with gold mostly unchanged. The last 2 days, you know, we had this really nice rally, and now we're pretty much in a consolidation zone that started pretty much, well, looks like at lunchtime yesterday. We haven't done much on gold since then. The VIX is now at 1943, so we're seeing some, I would guess you could say, normal readings on the VIX, still higher than what we've experienced through most of the year, which was in that 9 to 12 range. You can see declines are leading at this point. And let's go ahead and look at our predefined alerts very quickly so we get an idea of what's going on. So healthcare sector has got a BPI. It crossed over 50, so healthcare sector might be interesting to take a peek at. The euro is crossed above 125, as you can see. NASDAQ, we looked at that chart, and it is continuing higher and now was over 7,200 as of 10 this morning. And S&P 500 as well, and Dow, all crossing, having very bullish crossovers at this point in time. I'm going to be curious to see what that does to the decision point signal board. We'll have to take a peek at that tonight when I do my blog. And finally, I'm going to finish with the market summary here. And that'll give us an idea of what industries are leading right now, which are lagging. And as you can see, sector spiders, utilities is leading. It's usually in the bottom, so it's good to see that up there near the top for a change. Technology and staples are also leading. Somewhat defensive sectors when you look at utilities and staples. So we're seeing those rotating kind of to the top at this point. Energy is the only laggard now, almost down almost 0.75%. As far as our U.S. industries, telecoms, computer technology, utilities leading the way. And gold, oil, and oil services are the laggards, currently with oil services down over 1.25%. As far as international ETFs go, we can see South Korea and China are leading currently, both up over 2%. And the only laggard as far as going in the negative is the India ETF. This one is falling, but we see positive action on all of the other international ETFs that we cover. And with that, I'm going to pass it back to you, Tom, so you can talk a little bit about some of your anatomies of a trade, and I will get mine ready to go.
All right, sounds good. Yeah, just one other final comment. You can see on the spider chart right here, we are now with this strength just about touching that reaction high. So this is going to be a really interesting afternoon. If we take a look at, say, the hourly chart going back 1 month on the S&P, try and pull this up. You can see right about where we are here. Look at the high. This was that reaction high I talked about. So if this is an inverse head and shoulder pattern, we could see some selling kick in. What I'd be most nervous about, I think, is if we get a tail later this afternoon above this move and then failure and come back down below. So I'd be looking for that. But as far as the anatomy of a trade, I'm going to show you a few trades. And I actually sold a bunch at the open, partial positions. And I'm waiting to see how the market closes today before I decide what to do with these. But all of these I owned, and all of these I sold half at the open, and I'm just waiting. So Varian Medical, actually, this was one of the setups I did back on Monday. I think this was a Monday setup that I had. But this one is done very well. Had a beautiful reversal off of price and gap support. Here are the revenues and earnings per share. So I always like to buy off of my strong earnings chart list. Varian was on there. I thought it was one of the best reactions to earnings reports this quarter. And so it came all the way down and reversed at gap support last, I think it was last Thursday. And so this one has been a really nice trade and still looks good, by the way. PTC, another one with a beat on the top line, beat on the bottom line. Here was your earnings reaction, gap up. This was another one of those black candles where we continued to move higher on strong volume. But because of all the market weakness, we saw it actually come all the way back down to both gap support here and price support from this level. Nice reversing candle. There was a false breakdown. So intraday move down below, but we came back up and we held. So this one looks to me like my target was 74.5. But again, I sold half at the open just because the market was getting very close to a key resistance level. And if the market turned down, most stocks were probably going to go down with it. But I do anything back up over 74, I'll probably be out of this one later today. Notice the volume, too. Very light on this move back up. It's going to need more volume, I think, to get a breakout. But the relative strength, I think, is apparent. The next one I had is Costco. Costco on this pullback, you can see into the gap support zone. Also, check out the revenue and EPS, topping expectations. Again, we got the big reversal, false breakdown, and you can see Costco continuing to perform very well. I also had 2 ETFs. I'll just bring these up real quick. XRT on a daily chart, and let me just show you on the daily chart. We had a negative divergence. I talked about this going into January when the XRT broke out. You can see that the PPO was negative. So I'd been waiting for a while for some weakness in the XRT. We finally got it because of the market pullback. And while on the daily chart, it doesn't look all that exciting. Again, I think if we go back to that weekly chart, and you can see that that came down and tested the rising 20-week moving average and is performing exceptionally well. 46.25, though, is the area of that most recent reaction high. And you can see we tested that earlier today. So again, this is one I want to watch into the close. And then finally, the last one I have is the XHB, which pulled back very close to a key support level last week, hitting, putting that tail in on very heavy volume before reversing and putting in a hammer. But this is another one on a relative basis, not really performing as well as the overall market. And there are going to be some key housing reports coming out over the next couple of days. So we'll see whether or not we can get through on those reports. But I'd be very careful from 43 to 43.5 on the XHB.
All right. I only have one today, and I've got my screen up here. Let's get this bigger. So I decided to go back and look at my Monday setup, and of course it's a head smack moment. Fortunately, I have a lot of those because I paper trade more than I actually trade a lot of times. And in this case, the Monday setup is working pretty good right now. So let's look at what it looked like when we went in on Monday. So I picked it because we had this really nice gap. It looked like a breakaway gap after hitting this bottom. I thought that was good, and we were still marching up past that. So today is Thursday. We got in right around 2012, currently at 21.48. So this is turning out pretty good. But notice the target was hit. So now it's time to reevaluate. And so that's what I did up here. So if anybody's following along on this trade, I do not know. And sometimes I hope you don't, because it puts a lot of responsibility on me. But that's why I put these stops in, just so you know where the support lies and where you might want to be thinking about getting out. But look at this. This chart is still looking so great. And again, head smack moment came up on the radar for me on Monday, obviously. We now have the buy signal. Look at the OBV is just confirming this move. You can see rising bottoms matching with the PMO rising bottoms, all looking good. So we broke out above my target, which was about 21. So then what I ended up doing actually was going to the weekly chart because I wanted to figure out what a good target would be now that I've hit my target. And what I'm noticing is this really nice breakout above this bottom that we had back in 2016. We're now seeing that breakout on the weekly chart. PMO looks strong. It's not overbought. So where would I set my next target? I'm looking right about here at these bottoms that we've got back here in 2015 and 2016. So my target, I'm going to move up to, almost 24. And I think I ended up picking, what did I pick? 2350. I decided I wanted to get, what I do is I set up predefined alerts. So I get either a text or an email when my stops or when my targets are hit so that I can go in and reevaluate. And so I did that. And so my new stop, I'm putting it about 2025, and I'm making it a mental stop because I'm willing to go down to this $20 level, but I want to see what's going on with my indicators if we start getting a drop that low. And as I said, I've set my target right around 2350. So that's a trade that's ongoing, and we'll see how it shapes up by Monday. So that was mine. And I don't know if you had I don't think, Julius, we have time exactly for you to do an actual trade today. But I think you kind of went through a lot of that. And I know you're taking questions in the chat room. So
I've noted a bunch of questions. I'm not sure how much time we have. I can try to address a number of them. And I've actually, while you were talking, looked up something that I posted on Facebook a while ago. It was a currency trade, but it will serve as an example of how I pick trades and what happened. So shall I pick the screen again from you?
Yeah, absolutely.
Yeah. All right. So then.
Yeah, you've got another probably 3 minutes or so. If you can go.
All right. Okay. So quickly, this is my Facebook page. It's the RRG Research Facebook page. By the way, someone asked if there was an RRG website. That's relativerotationgraphs.com. It's pretty static because stockcharts.com is, as we agreed, the home of RRG on the web. So primarily everything I do on RRG web-based retail space is all for stockcharts.com. There is an RRG website. Please go there, have a look. If you have any questions, I'm available. But be aware that all of my blogs pretty much are on stock charts. And if you look at the blog on the website, they're pretty much all links to blogs that I wrote for stockcharts.com. Now here's one that I did just as it's a little bit of a play because I was looking at some currency RRGs. And yes, you can do that on stock charts as well. And let me ask you a question, because what I posted here, why is this not working? Come on, please.
It's just how it happens live. It just always does.
It's dead.
So you do have a chart though on the Facebook page?
Yeah. No. This was a post that I posted.
Okay, got it.
I hate it. Why is that happening? Well, anyway, the top chart, which you cannot see, is an RRG of currencies. And what happens is that Euro dollar and Canadian dollar were moving in opposite directions. And I spotted that on the RRG. And then I draw the chart and I said, hey, this is interesting. 153 something is an important resistance level. I'll be watching that. And I just reposted that one because that happened on January the 22nd, and Euro Canada is now trading at 156. So this is how I plotted a potential currency trade using RRGs, which you can also do on stockcharts.com. Let me quickly go over. Someone, you can just grab my screen back because this is completely dead. I mean, it doesn't.
Okay.
Let me quickly go over a number of questions. Neil asks, picking stocks using RRG on outperforming sectors. Is picking top leaders not the way to go? Yes, it definitely is the way to go. It's basically what we discussed earlier on with the value segments and the size segments. In this case, you would do sectors versus the market, and then you would compare the individual stocks to the sector. So you'll pick the outperforming stocks in the outperforming sector, or the ones that you think will catch up fastest. Steve asks, are the only ones that you consider in blue? No, definitely not. They may be good opportunities, but when they are very far to the left, then I'd be very careful because they can rotate back to lagging. And also what we found is very interesting are stocks that are inside weakening, but rotating back up to leading. Those usually have very good performance. Two questions were related to weekly versus daily. I am going to point you to the stock charts chart school articles about that. It's pretty good article about weekly versus daily, which explains it. And if you will put it in the search box, you will also find one or two blogs where I've addressed that issue. Steve M asks what the time with regard to time frames and what the duration is. My background is in institutional space. When I came up with RRGs, I was working with institutional investors, and their time frame is usually a little bit longer term. And what I figured out is that on a weekly RRG, the trends that you pick up, I always told my clients that the trends that I pick up should last at least 3 months or longer. So on a weekly RRG, I am looking for trends, relative trends that are going to last 3 months or longer. And the experience is that many of them last much, much longer than 3 months, and only a handful, and those are the exceptions that confirm the rule, basically, are shorter. Steve, without an M, asks, are you using RRGs to evaluate short positions? And the answer is yes, 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 yes. Look at the example of the currencies. That's definitely a short sell for Canadians. This one I cannot read anymore. Bunny asks, I track a list of stocks in various sectors. Which benchmark should I use? I'd say SPX. Just put the stocks against SPX, and you'll probably see sector rotation among these individual stocks popping up. Jack asks about the thickness of the tails. Do they mean anything? Yes. The further away from the benchmark, the thicker the tail, and probably the more important or the more alpha you can generate following that move. How to read the RRG lines on the chart, the red and the green one on a normal chart, so the RRG lines. These are the inputs that actually make up the RRG chart itself. So the red one, the RRG ratio line, is plotted on the horizontal axis on the RRG. And the green one, the green dotted line, is the RS momentum line, and that's plotted on the vertical one. So those two should match what you see on your RRG. Make sure that you use the same benchmark and the same time frame. And then RVR, I cannot read my arm. I'm looking like a doctor now. It says do RRGs indicate a future path? They look great for the past. I put a smiley on it because, yeah, of course, it's just like any other chart. They all look good in the past. I think the benefit for RRG is that you can assume the rotational pattern to take place, which should give you a little bit of guidance on the future path of it. Now, again, there is just as much guarantee as with any other chart and trends that you spot on any other charts, but the rotational pattern is that, comes back time and time again on RRGs. So if you're looking for the future path, that's where I would be looking to continue its rotational path. And we're actually working on tools to actually put, chances and odds that something happens with spreads, etc., etc.
Hey, Julius.
And sorry, yeah, no, that's fine. There were two more, but please, find me on Facebook, Twitter. I'll answer anything.
Yeah, and you're going to be coming back. I mean,
I'll be coming back. Yes. Yeah, I believe that I've been cornered to do an RRG part every month.
Yes.
So there you go.
Yeah. So once a month at least.
Yes. So we can't get all your questions answered, but we will. No doubt about it going forward.
For sure.
It's been a great session. I know everyone. You could tell by the responses and so forth in the chat box that everybody really appreciated you coming on. It was fascinating. I think everybody learns a little bit more about RRG every time you show up. So we're looking forward, obviously, to your next visit as well. But again, thanks, my friend, for joining us today.
Thank you very much, Tom and Erin. My pleasure. And everybody who's listening.
Yes. Well, here's our weekly schedule up here real quick. I'll be doing my bull bear market rules tomorrow. No market watchers on Monday. Arthur's coming in for me on Tuesday, and Greg will be here Wednesday.
Sounds good. Do want to thank everybody for joining us, and especially our special guest and friend, Julius. Wonderful having him on today. Please remember to complete the survey as you exit. We'd love to get your feedback, especially what you think of the RRG charts and the presentation today. As a reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Thursday afternoon, everybody. We will see you back here on Friday. Happy trading.